They told me markets had changed. They said my old methods were obsolete. They insisted technology made my work irrelevant. And yet, here we are. The same patterns, the same human fear and greed, playing out on the screen. The truth is, they weren't trading rules, they were rules about people. And people haven't changed a bit. The pixelated screen of today shows the same heart rate of the crowd that the ticker tape did 50 years ago. My methods weren't built on software, or tested on some fleeting algorithm. They were forged in the pit, watching the sweat on a specialist's brow, hearing the panic in a voice, feeling the tangible tremble of uncertainty that hits every single soul in the market when a position goes against them. That vibration, that's the data that matters. That's the only data that ever has. The core principle, the bedrock of everything I did, was and is the commitment of traders. Where is the money going? Who is getting hurt? Who is about to throw in the towel? I measured that not with sentiment indicators cooked up in some PhD's thesis, but with raw price and volume. The Sen-R oscillator, the volatility expansion, the study of week-offs accumulation and distribution, these weren't invented, they were discovered. They're the X-rays of market structure, revealing the skeleton of supply and demand that all the fancy quantitative clothing can't hide. Let's be brutally clear, the high-frequency traders and the algos haven't replaced the game. They've just become the newest, fastest herd. They amplify moves, they create liquidity voids, but they operate on logic that can be anticipated. They create even clearer, more violent manifestations of the old signals. A sell signal in a market dominated by machines isn't weaker. It's often more catastrophic and therefore more profitable, because the machines have no stomach for pain. They just follow their code, and that code can lead to a stampede. So when someone says the old ways don't work, they're confessing they never understood what they were looking at in the first place. They were memorizing a painting instead of learning to see the brushstrokes. The canvas is bigger, the paints are digital, but the artist is still the same emotional, reactive human animal. The patterns of accumulation before a rise, of distribution before a fall, of climactic volume signaling exhaustion, these are eternal. The tools I built simply measured the intensity of that human condition within the price stream. The numbers on the screen are a biography of mass psychology, and that story has no new chapters, only new verses. Consider the pit. The chaos, the shouts, the flurry of paper tickets, the raw stench of fear and adrenaline. That was the original interface. A man would look into another man's eyes to gauge conviction. He'd hear the tremor in a voice giving an order. The market's pulse was taken through human sensory input, the widening of pupils, the slump of shoulders, the desperate scramble for a bid. The data stream was analog, biological, and transmitted through the air. Now, look at your workstation. 4 clean, cool monitors, silent except for the hum of fans, clicking mice tapping keyboards. The interface is digital sterile, composed of pixels and photons. It feels like a different universe entirely. This is the grand illusion. This is the surface level change that convinces so many that everything beneath must be new, must be different, must require a new gospel. They mistake the monitor for the market. They conflate the delivery mechanism with the message itself. The screen is merely a translator. It takes the same underlying forces, the collective hope, greed, fear, and desperation of every participant, and renders them in candlesticks, moving averages, and order flow ladders instead of facial expressions and open outcry. The medium transformed, but the message is identical. The heart of the matter is, and always has been, the human heart. The neurological wiring that triggers panic when a position moves against you hasn't been updated. The biochemical rush of euphoria from a winning trade is the same ancient cocktail. The herd instinct that causes a stampede into a rally or a cascade out of a decline is not a function of technology, it's a function of the limbic system. A piece of hardware in our skulls that hasn't had a software patch in over 100,000 years. Every algorithm, every quant model, every high-frequency strategy was ultimately coded by a human being, and that code is built upon human assumptions, human interpretations of history, and human emotions like over-optimization and the fear of missing out. The machines are faster, granted. They process information at speeds we cannot comprehend, but they are processing the same emotional residue, the same footprints of mass psychology left in the price data. They amplify the moves, they compress the timeframes, but they are dancing to the very same tune. They are the new, hyper-efficient herd animals, but they are herd animals nonetheless, following momentum and fleeing risk in a predictable, programmed manner that often leaves even clearer trails in the chart for those who know the original language of the market. So when you stare at that pixelated chart, you are not looking at a new reality. You are looking at a high-definition mirror. It reflects the same primal emotions, the same cycles of accumulation and distribution, the same climactic exhaustions that have driven markets since the first traders gathered under a buttonwood tree. The flickering light on your screen is not a new sun, it is a very old fire, now contained within glass and silicon. The only thing that has truly evolved is the clarity of the reflection. The noise of the pit is gone, stripped away, leaving behind the pure, unadulterated signal of price action. The final, truthful expression of all that human fear and greed, now displayed with a precision the floor traders could have only dreamed of. The screen didn't change the game. It just removed the fog, allowing the timeless patterns to emerge with a stark, undeniable visibility. The flash of a green candlestick, the plunge of a red bar. These are not mere fluctuations in value. They are hieroglyphs. They are the physical markings left by a psychological battle. Every pattern we claim to discover, the head and shoulders, the double top, the parabolic spike, these are not creations of the market. They are artifacts of human nature, etched into the price data by the consistent, repetitive cycles of mass emotion. We didn't invent technical analysis, we are merely archaeologists, brushing the dust off pre-existing formations that were built by the human psyche long before the first stock exchange opened. The chart is a fossil record of fear and greed. Think of the most reliable patterns. What is a classic week-off accumulation but a map of stealth? It depicts the large interests, the so-called composite operator, quietly absorbing supply from the public who is disillusioned and selling in despair, all before a markup begins. That is not a market pattern. That is a pattern of power, patience, and exploiting emotional exhaustion. It is a playbook of human manipulation that works in any arena where assets trade, from ancient grain markets to modern crypto exchanges. The spring, or the terminal shakeout, is not a chart event, it is a psychological torture device, a final engineered spike of fear to pry loose the last of the weak hands before a rally. These formations are blueprints of a very old game, or consider the climactic volume spike at a market top. That isn't just high volume. That is the scream of the crowd. It is the point of maximum public participation, where the last hesitant buyer finally capitulates to greed and rushes in, and the smart money distributes its shares into that frenzy. The subsequent drop isn't a random event. It is the inevitable hangover after the emotional binge, the V-bottom reversal. That is the sound of panic being extinguished, of selling exhausting itself, because there is simply no one left who is willing to sell at those prices, triggering a vacuum of demand. These are not calculations. They are emotional resonances. My methods, the indicators like a SEN-R, were never about predicting price in a vacuum. They were engineered to measure the intensity of these underlying psychological states. An overbought reading isn't a sell signal because a line crossed 80. It's a signal because it quantifies a state of extreme emotional exuberance, a condition that is, by its very nature, unsustainable. It is a measurement of the crowd's fever. A bullish divergence at a new low isn't a buy signal because of a pretty picture. It signals that the force of the downtrend is weakening, that the emotional despair is no longer capable of pushing prices down with the same velocity, revealing a shift in the internal pressure. The chart is the X-ray. The patterns are the bones. But the flesh and blood, the life force that moves it all, is the timeless, unchanging drama of human psychology playing out on a logarithmic scale. We are not reading prices. We are reading people. The obsession with complexity is a distraction, a magician's trick to pull your eyes away from the truth happening in plain sight. You can layer on a dozen indicators, parse news sentiment with AI, track the tweets of billionaires, but it all ultimately crystallizes into two primal, undeniable facts on the chart: where is price, and how much force was behind its movement. Price is the final vote, the ultimate consensus of value at that exact millisecond. After every argument, every algorithm, and every emotional impulse has been tallied. Volume is the conviction behind that vote. It is the energy, the fuel, the proof of commitment. Together, they form the only real story. Everything else is commentary. Think of a market rally on thin volume. It's a parade with few spectators. It looks impressive on the surface, the line moves up, but there's no substance, no broad participation. It is fragile, built on air, because the force behind it is weak. It tells you the big money is not committed, it's just a short covering squeeze or a few opportunistic bids. Now, contrast that with a rally on expanding volume, particularly as it breaks through a key level. That is the sound of a dam breaking. That volume is the rush of new conviction flooding in, the proof that real buyers are committing real capital, overpowering the sellers. That is a shift in the balance of power you can measure and trust. It's not a prediction, it's a physical observation of force. The same truth applies to declines. A slow grinding drop on low volume is distribution, the stealthy passing of assets from strong hands to weak ones. But a plunge on soaring, climactic volume, that is panic. That is the emotional climax where the last holdouts are being washed out. That volume is the sound of surrender. It is the market screaming its emotional state. These are not subtle clues. They are the market shouting its intentions in the only honest language it has. My work was always about tuning out the noise and learning to hear that shout. All the sophisticated smart money. Concepts boil down to this: tracking where the volume is confirming price and where it is diverging. Accumulation happens in the shadows on down bars, but often on suspiciously high or stabilizing volume. When the news is bad, that's the signal of absorption. The spring, the final shakeout, is almost always marked by a volume spike that fails to take price significantly lower, revealing the exhaustion of selling pressure. These are footprints in the data. They are the traces left by the major players because they cannot move size without leaving a volume signature. They can hide their orders across time and price, but they cannot hide the total energy of their transactions. By focusing relentlessly on the marriage of price and volume, you are watching the actual mechanics of the market's engine, not just the pretty lights on the dashboard. You are seeing who is winning the tug of war by measuring the strain on the rope. It's the greatest misconception in modern trading, to believe the machines have replaced the herd. They haven't. They've simply become the herd, operating at a speed and with a coordination that earlier generations could not fathom. The emotional, reactive crowd on the exchange floor has been supplanted by a cold, logical crowd of servers in a data center. But a crowd it remains. The essence of collective behavior, the stampede, the rush for the exit, the frenzy to buy the breakout, has not been eliminated. It has been encoded, automated, and accelerated. The herd instinct didn't vanish, it was uploaded. And in many ways, this makes its movements more predictable, not less. These algorithms are not sentient. They are rules. They are programmed to follow trends, to sniff out liquidity, to execute arbitrage, to react to specific price levels or volatility metrics. They are designed for consistency and speed, not wisdom or discretion. What this creates is a new kind of market physics. Their collective actions amplify trends with a mechanical efficiency that a human crowd, with its hesitations and second guessing, never could. A small break of a technical level that might have drawn a few human orders in the past can now trigger a cascade of algorithmic orders, creating a violent, almost instantaneous move. This isn't chaos, it's programmed momentum. It is the herd mentality, stripped of emotion but turbocharged with processing power. This creates a profound irony. In seeking to remove human fallibility, quants have built systems that are hyper-sensitive to the very patterns created by human psychology. They are trained on historical data, which is just a recording of past human decisions. They are optimized to recognize and exploit technical formations that are, as we've established, themselves artifacts of crowd behavior. So when a classic chart pattern emerges, it doesn't matter if a human or a machine recognizes it first. The machines will see it too, and their reaction will be faster and more monolithic. They will pile into the trend with a force that validates the old pattern on a grander, cleaner scale. The old trader had to gauge the mood of the pit. The new trader must understand the logic of the server farm. The fear in the market is no longer just the sweaty palm of a fund manager. It's a volatility spike that triggers a risk-off subroutine in 10,000 algorithms simultaneously. The greed is the momentum cascade as trend, following bots pile into an upward move. These are the new herd dynamics. They do not invalidate the concepts of accumulation and distribution, of overbought and oversold conditions. They simply execute them with a breathtaking, robotic precision that leaves even clearer footprints on the chart. The shakeout is faster. The climax is sharper. The moves are more extreme. But the playbook, the map of how a crowd, whether biological or silicon, enters and exits a market, remains exactly the same. You are not watching a new animal. You are watching the same beast, now wearing a suit of blazingly fast armor. This is the critical flaw in the thinking of those who believe machines operate in a pure, emotionless vacuum. They forget the programmer. Every line of code, every parameter in a quantitative model, every weighting in a factor-based algorithm was written by a human being. And that human being embedded their own understanding of the market, understanding built on historical patterns, psychological biases, and assumptions about future behavior, directly into the machine's logic. The algorithm doesn't feel fear, but it is programmed to react to conditions that a human has defined as dangerous. It doesn't experience greed, but it is engineered to aggressively pursue scenarios a human has labeled opportunistic. The machine is an emotionless executor, but it is executing a playbook dripping with human emotion and expectation. Therefore, these systems don't transcend market psychology. They become its most potent and literal-minded enforcers. They act as force multipliers for human sentiment. When a human-defined threshold for overbought is reached, 1,000 algorithms may begin systematic selling, not because they are scared, but because their code defines that condition as a sell signal. This creates a self-fulfilling prophecy on a massive scale. The anticipation of emotion is hardwired into their core functions. A volatility spike isn't just data to a machine. It is a trigger that was put there by a programmer who knows that sharp volatility spikes often coincide with human panic. The algorithm is anticipating that panic and acting preemptively to avoid the losses associated with it. This allows a sharp trader to think one step ahead of the silicon herd. By understanding the classic psychological signposts, the extreme sentiment readings, the climactic volume, the parabolic moves that signify exhaustion, you are effectively seeing the triggers being loaded into the market's firing mechanism. You know that a certain oversold level on a reliable oscillator isn't just a historical curiosity, it is a specific line in the sand that thousands of systematic strategies are also watching. A break of a major support level isn't just a technical event, it is a siren that will activate a cascade of stop-loss algorithms and trend-following sell programs. The reaction is not emotional, but it is utterly predictable precisely because it is a reaction to the conditions of extreme human emotion. So, the game evolves. You are no longer just watching for the crowd to become euphoric. You are watching for the point where that euphoria will be so statistically obvious that the machines, acting on their human-coded instructions, will begin to reverse their positions. Emotion. The code anticipates is the very same emotion you are trained to identify. This doesn't render the old psychology obsolete. It confirms it as the fundamental bedrock of all market activity, now so widely acknowledged that we have built our most advanced tools explicitly to react to its manifestations. The algorithm's cold logic is forever chasing the ghost of human feeling, trying to predict its next move. And by understanding the ghost, you can often predict the machine.